Live from Bloomberg's world headquarters in New York, I'm Scarlett Fu.
And I'm Tim Stenovec. Welcome to the newly expanded one-hour edition of Bloomberg Crypto. We'll look at the people, transactions, and technology shaping the world of decentralized finance.
Here is what's at stake today. The crypto winter rolls on. The price of Bitcoin remains under pressure. We discuss the fallout from ETFs and VCs to longtime holders of the digital asset.
In just a few moments, we're going to speak with David Marcus, the co-founder and CEO of Lightspark. He's a former executive over at PayPal, too. We're going to get his take on all this volatility and his recent comments regarding PayPal's CEO change.
And fresh off the Seahawks' Super Bowl win, we take a deep dive into the growing boom of prediction markets.
That's all ahead over the next hour right here on Bloomberg Crypto. But after a relatively quiet start to the week, Bitcoin is sliding yet again. We're seeing it right now at 69,470. This adds to its longest losing streak since 2018 if we look at it over the whole month. I do want to point out here, look what happened on the 5th. That was last Thursday. Fell more than 13% to recover Friday, up 11%, above 70,000 for much of the past few days, but just shy of $70,000 as we speak. The question is about the outlook, and it's looking bearish. Bitcoin derivatives are flashing warning signs. Traders are still positioned defensively, and little signs, Scarlett, of new bullish bets.
Remember back when Bitcoin was making its run towards $100,000? At the time, Bitcoin ETFs are credited with driving demand. So this chart shows the overall value of Bitcoin ETFs. Their market cap peaked at around $168 billion back in October. Post-crash, they slumped to as low as $80 billion in January. They've since recovered modestly to just under $90 billion.
Matt Hogan from Bitwise says this is actually a buying opportunity.
I think this is a traditional crypto winner, will round out, and I think the people who dollar cost average in now may be happy in the future that they do it because I think the long-term trajectory is solid.
All right, Hogan is still bullish. Joining us from Hong Kong is Gracy Chen, CEO of the crypto exchange Bitget. Do you agree with Matt Hogan, or is that what you're seeing people do on Bitget, Gracy? Are they actually buying Bitcoin? Are they dollar cost averaging in at these numbers?
Well, our data is an aggregated data in terms of all the users. Of course, there's some users who are selling. But actually, I was having a dinner with about top 10 of our traders and institutional clients. I think a general sentiment over the dinner is this is a good time to do dollar cost averaging, or even just directly buy and hold, especially if you are looking at about a 3-year time horizon. So yes, I do agree with Nate.
Okay, so I guess one question I have here is, Tim was just showing us the crazy day that Bitcoin had last Thursday, how it swung all over the place. And much of that happened even before the U.S. trading day began. Which part of the trading day is the driver here for Bitcoin prices? Is it Asian trading hours? Is it U.S. trading hours?
I think the last week's decrease, quite some of them come from the Asia trading hours, as you pointed out, even before the U.S. starts the day. I was actually in New York last week, although now I'm in Asia. But at that time, we actually, as an exchange point of view, we saw some very crypto native kind of liquidations. I think that's a pattern followed with the last year's 10, 20 billion long squeeze. And the market liquidity since then is kind of like severely impaired, with actually exchange volumes down 20 to 40% on average. So that created like a fragile environment where any selling pressure is quite dramatically amplified, leading to these steep cascading kind of declines.
Well, Gracy, that's certainly what we saw on the downside, but I'm wondering about catalysts for the upside here. We've got a bill stalled in Washington. I guess crypto folks got some more clarity with at least what they want to see out of Washington. What's the next catalyst then to get Bitcoin higher?
I would look at mainly two catalysts. The number one is still macroeconomics, especially around the Fed policy, around monetary policy. When do we start a QE? When do we do more interest rate cut? And of course, the the nomination of Kevin Warsh, who is a known policy hawk, a few weeks ago, is as the next chairperson of Fed, has kind of shifted the market expectation. But I personally think, this very high interest rate wouldn't be sustainable. We will face a QE. And generally, globally, we are seeing more M2 supply. M2 global supply has been climbing up and up. And of course, that drives a lot of price increase in gold, silver, and some other commodities. Of course, a little bit down last week, but gold and silver perform much better than Bitcoin. And I do expect Bitcoin to catch up. Another catalyst we're observing and paying close attention to would be RWA and how, maybe not just RWA, but also PayFi and stablecoin. Because with more integration of TradFi versus crypto through things like tokenized assets, tokenized stocks, ETFs, gold, silver, forex, etc. I think that's where we see more mass adoption of cryptocurrency in general.
What's notable, I suppose, is in this current crypto winter, there's a whole slew of reasons why Bitcoin is selling off so much. Whereas in the past, in 2018, you had the bursting of the initial coin offering bubble. In 2022, you had FTX and Sam Bankman-Fried. This time, it's a little bit of everything. Michael Saylor of Strategy says that your time horizon in crypto needs to be at least 4 years because Bitcoin tends to move in these 4-year cycles. What does that look like, Gracy, now that you have institutional investors very much in the mix compared with those previous cycles?
I feel if we are still talking about this topic of 4-year cycle, then 4-year cycle is here. But the 4-year cycle is indeed a little bit smoothed out by the TradFi world, by the macroeconomics, because in this current crypto cycle, the major capital inflow does come from ETF and DAT, at least according to the last two years or so. So those kind of money or capital are more influenced or sort of priced by Wall Street and more influenced by macroeconomics, by the integration of TradFi world. So that's why I think the 4-year very crypto native kind of mindset will be smoothed out a little bit by ETF and DAT and by some other macroeconomic events.
Gracy, we did see at its lows just last week, we did see Bitcoin fall more than 50% from its highs back in October. Scarlett mentioned a few things that are different in terms of this crash, but one other thing that's different is institutional adoption from Wall Street, and then also the fact that we have spot Bitcoin ETFs. In your view, should that have prevented a wipeout like we saw?
Should that prevent? ETF and DAT money are more of a good representation of Wall Street and of the US liquidity. So I don't think Wall Street is necessarily long-term holder. People are just looking at different asset classes across stocks, ETFs, commodity, Bitcoin. And Bitcoin is just like one of the other asset classes. So, So back to your question, I think my point is ETFs and DATs, and especially the capital inflow here, will make their own decision, and they will sell when they think it's a good time, when they make some profit or so. But again, back to the foundation of Bitcoin and cryptocurrency, it is a very pure reflection of liquidity. So when we see more direct QE, I do expect Bitcoin to increase again. So actually my kind of like time horizon for holding or trading Bitcoin and some other major blue chip cryptocurrencies would be slightly more long run, because I'm a builder in this space. And I think in 2, 3, or even 3, 4 years time, if we look at that time horizon, the Bitcoin price of 70K should be relatively low.
Gracy, always good to see you. Thanks for staying up later, early in the morning in Hong Kong. Really appreciate your time. That's Bitget CEO Gracy Chen. Well, coming up, David Marcus of Lightspark is joining us. He's going to share his thoughts on crypto price action, as well as his former firm, PayPal. Just a reminder, to access all the latest data and news on crypto, just check out CRYP Go on the terminal. This is Bloomberg.
There's been kind of like a seller's virus that got into the market. People blamed it on quantum. I don't think quantum in the long run is really the reason. I think there was selling, and that selling is getting, executed in the market. There was buying, sure, lots of new institutions are coming in, but prices are set on the margin and there have been more sellers than buyers.
That was Mike Novogratz, Galaxy Digital CEO and founder, speaking with us last week on this volatility in Bitcoin price action. So I want to bring in now David Marcus. He is a former president of PayPal, a former senior executive at Meta as well, currently the CEO and co-founder of the payments platform Lightspark. And David says he is still bullish on Bitcoin. So David, let me start there on the price action that we've been seeing. Crypto has had this terrible, horrible, no good, very bad 2026 ever since the events of October 10th. What do you chalk up this weakness to, this volatility to?
Well, I think there's a lot of structural pressure on Bitcoin that's been happening after 10/10, and I think your guests on the show have spoken at length about this. And I think, it's just a change of who's holding Bitcoin, and you're moving from people who had long-term belief and were holding Bitcoin directly to just access to Bitcoin being wired up to our financial system and markets in ways that didn't happen before. So the combination of what happened on 10/10 plus the mix shift change of who's holding changes the dynamic of price action. But I think, look, at the end of the day, as far as Bitcoin is concerned, this is not, a short-term market play. You have to have long-term belief and vision of, what it does in terms of an edge to everything else that's happening on the market. And I think that for those people who have that long-term belief, they'll be fine.
So I want to talk to you about your view of Bitcoin's role, because one thing that we've been discussing since last week is sort of this, what critics call an identity crisis for the cryptocurrency. And we didn't see it really as a safe haven, with the debasement trade. We saw gold actually move higher last year and this year, David, but Bitcoin didn't perform like, quote unquote digital gold. What is the use case for it?
I mean, look, I think the problem is if you're looking at it in timeframes that are fairly short, then you'll have moments where it does that. But I think that over the very long run, if you're holding Bitcoin for, say, the next 10 years, you'll probably do better than holding almost any other asset for the purpose of actually being a hedge to everything else that's happening, and debasement and money printing and all of these things. And I still stand by that. I think that in short periods of time, you'll see volatility and all kinds of different things playing into the price. In the long run, I think we'll all be better off holding Bitcoin versus any other asset, frankly.
What I found interesting about what you said regarding the holders of Bitcoin now is kind of how it's now institutional investors. It's kind of like the financialization of Bitcoin. And that brings me to something else that you've written about lately, which is PayPal, the company that you were formerly affiliated with. You shared your thoughts on the company some 12 years after you left. Obviously, there was some frustration there. You talked about how over time, the company had every advantage and could have become the most consequential and relevant payments company of our time, but it lost its mojo, its product edge, its ability to compete in a market that's being rewired and reinvented in front of our eyes. I guess the question here is, can it be fixed? And is crypto rails the way to do that?
Well, it's definitely one of the ways to do that. I think the company still has formidable assets. But I think, there's not a lot of time to actually fix whatever is left there. And yes, you sensed frustration because there was a tremendous amount, and there is a tremendous amount of frustration because this was kind of a crown jewel of this whole industry and clearly mismanaged for way too long. So I think I think there's still a way to save the company, so to speak. I think Venmo is a phenomenal asset. I think branded checkout is a phenomenal asset. I think they have better data than almost anyone else to underwrite credit better and change the funding mix of transactions for e-commerce. But look, the displacement has happened at a very large scale. Like, think about like the last time you used PayPal to pay for something on your mobile phone versus Apple Pay or Shop Pay for that matter. And you'd be hard pressed to remember that it used to be that like everyone used to pay with PayPal. So I think share of checkout, getting back in those checkout flows, using new rails like blockchains, stable coins, and others to actually expand globally definitely are all part of the solution here.
Should it be broken up in any way? Should they start to shed assets, in your view, David?
I mean, I don't know. I feel like there are definitely like bad assets in there. I named a few in the post. I think acquisitions that didn't really make sense for the company. But is that going to move the needle if you're trying to focus on what matters or not? Maybe at a marginal level, but it's just not going to affect the change you want. You really have to really blow up the way that they operate in a pretty profound way.
Does all of this present an opportunity for Lightspark, your company that you have now?
Well, I think it presents an opportunity for a lot of the companies and clients that are using Lightspark for money movement globally to enable businesses to accept payments from anywhere in the world in real time, 24/7. We have lots of clients that are actually eating into market share of PayPal right now, leveraging our network and our capabilities of global money movement. So it's indirectly an opportunity for us that newer players leveraging newer rails and newer capabilities are actually eating into PayPal's market share.
I want to ask you about your move to support President Trump. In July 2024, you posted something on X saying that you're crossing the Rubicon and backing the Republican Party and President Trump, saying that you believe we need a president who is unequivocally pro-America, pro-Constitution, and you cited Bitcoin and crypto in there. More than a year into his term, do you believe President Trump has delivered on the things you were looking for from him as a pro-crypto president?
Well, I mean, it definitely beat the alternative by a long, long margin. I think that, if you look at where we were under the Biden administration, where you literally had a government that was trying to kill an entire industry and actively kill an entire industry, to a government and administration that is setting up the rules of the road for crypto, for stable coins, for digital assets to actually be innovated on in America instead of abroad. I think the outcome is really clear, and we're much better off. And I think you'd be hard pressed to find anyone in the industry that feels differently.
Should the U.S. government buy Bitcoin? There's been some discussion lately about back at the reserve. The reserve right now is just seized assets. Should the U.S. actually spend taxpayer money to buy assets?
No, I don't think it should spend taxpayer money to buy assets. I think rotating off other assets into Bitcoin in a very cautious way and slowly, I think potentially makes sense. But I
meaning
don't
like
think
gold, like selling gold to buy Bitcoin.
I mean, Bitcoin is so much better than gold. Come on, it's a no-brainer. But I do think that we need to be cautious about this, because if a government actually buys into Bitcoin at a very large scale, and then you have another administration that comes in and changes their minds, long term, it could have very negative impact on Bitcoin. So that's why I'm saying the government should potentially rotate a very, very tiny slice of its gold reserves into Bitcoin reserves, but do it very slowly and deliberately, and not rush into it. I think that would be my preference, or don't do it at all. But I think being too bold here might fire back long term.
David, don't be a stranger. Come join us again soon. Appreciate it. Lightspark's David Marcus joining us from Los Angeles. Well, coming up, the Fed's Chris Waller weighs in on the sell-off after the industry was championed by the White House. We dive into that next. This is Bloomberg.
I'm Norma Linda. Let's take a look at your midday movers. First up, Alphabet is set to raise almost $32 billion in debt in less than 24 hours to fund its AI capabilities. The company's debt sale includes an ultra-rare 100-year note in the sterling issue, which has drawn close to 10 times orders for the £1 billion offer. Meanwhile, S&P Global reported a 2026 profit forecast that fell short of analyst estimates. It said it sees billed issuance growth turning negative in the fourth quarter. And finally, Coca-Cola gave a full-year sales outlook for 2026 with organic sales growth of 4 to 5%. That's lower than the average analyst expectation. Sticking with the consumer, U.S. retail sales unexpectedly stalled in December, suggesting consumers provided less firepower for the economy as the year drew to a close. Those are your midday movers. I'm Nora Melinda.
All right. Thanks so much for that, Nora. Now to the political exchange in Washington. Fed Governor Chris Waller saying this week that crypto sentiment is turning on the White House. Here's what he said, quote, "Some of the euphoria that came into the crypto world with the current administration, some of that's kind of fading. I think there was a lot of sell-off just because firms that got into it from the mainstream finance had to adjust their risk positions, sell, lots of other things." Chris Waller making these comments at a conference in La Jolla, California yesterday in the middle of the day. Couple things here, Scarlett. One, I go back to what Gracie said. I was kind of surprised. We had to end our interview with her, unfortunately, Gracy Chen over at Bitgo, but she said that Wall Street's not in it for the long term. Like, they're not long-term holders. And I guess what I took away from that was, they're trading. But then, we speak just now to David Marcus, who says, this is the type of thing to hold on to for, a 10-year period.
I mean, definitely some folks on Wall Street are seeing this as just another speculative opportunity, but there seem to be plenty who are in it for the long haul, who are making room in their portfolios, truly allocating assets to the crypto world. And Chris Waller has also characterized the recent crypto market volatility as part of the game. So this idea that, you rotate between different asset classes, eventually you hit on crypto, and maybe you come out of it at some point.
Look, people who've played this game for long enough, they know that after the FTX collapse, there was a 70% drawdown. They know that, back in 2018, there was a more than 70% drawdown. They say this is just part of how it works.
Part of that 4-year rotation.
Investing in Bitcoin.
Well,
if you have the stomach for it.
Yeah, absolutely. Stomach of steel, right?
Well, coming up next, we're going to talk the rising role that crypto is playing in prediction markets and more. Adam Morgan McCarthy is joining us. That's next on Bloomberg.
Welcome back to Bloomberg Crypto. I'm Scarlett Fu alongside Tim Stenovic.
It's time now for the odds. We're going to look into prediction markets. The industry saw massive growth to close 2025. And right into this year's marquee U.S. sports event, the Super Bowl, we're going to break down the different parts of the market. We're going to start with jump trading. It's set to gain small stakes in Kalshi and Polymarket. According to people familiar, the firm will provide liquidity on the prediction market platform. Bloomberg's Kat Doherty joins us now. What can you tell us about the way this deal could go down?
Yes, so this is not an unusual agreement between market-making firms like Jump Trading. All that means is that they're stepping in to make sure that there's always trading. They're facilitating the buying and selling. When there's a position, a yes or no contract, they're stepping in to take the other side. And they're not the only firm that's doing this. Of the big institutional players, Susquehanna is another trading firm that is present not just in prediction markets, but you know them from other asset classes, equities, options, futures. So Jump, this agreement today that we are reporting on is mostly about them being a partner to these prediction market platforms. They're saying, we will provide liquidity, we will trade on your platforms, and in exchange, we're going to take a small stake, an equity stake in these growing companies. This is an asset class that is really in early days. So having partners like Jump Trading is important for them in order to keep that momentum going and make sure that there's going to be strategic venture capital that is growing on both sides.
Okay, so prediction markets need market makers like Jump Trading, like Susquehanna. How many firms do exchanges tend to need? Are 2 enough? Is 10 enough? What does it look like?
So what's interesting about prediction markets is right now the liquidity has not gotten to the point at all where we're reaching, let's say, if you were thinking about the equity markets or futures. But you do need both the big institutions like the ones that you're mentioning and smaller players. So, for example, in prediction markets, you have trading firms and even a few people in their basement that are trading predictions on weather contracts. And they're developing this expertise around certain areas. So it could be sports, it could be other pop culture moments. And so it's a different asset class. It's not these firms that are starting out like Jump, like Susquehanna. They have to make sure that they can develop an expertise that is outside of what they're used to in equity and other more institutional or traditional marketplaces.
Kat, before we let you go, speaking of tradition, is it another example of what Scarlett talks about all the time, which is like TradFi actually getting into this new asset class? And I'm not saying prediction markets are an asset class. What I'm saying is that a lot of times these are built on the rails of cryptocurrencies. And is it a way for TradFi to get exposure to crypto?
I do think so. And what's interesting, if you talk about Jump, they had Jump Crypto. And so they're used to playing in not just crypto markets, but as a venture firm, they invest in blockchain technology. They're used to really jumping before everyone else is. So they're, I would say, an early player in a asset class like crypto. And right now you're seeing it in prediction markets.
All right, good stuff. Katherine, Doherty, thank you so much, keeping us up to date on the latest when it comes to traditional finance getting into prediction markets. And of course, the rise of prediction markets is just the latest step in the ongoing institutionalization, financialization of the gambling world, which has taken professional sports bettors further and further from the old world of sports books in Las Vegas or Atlantic City. That was the big take written by our own Ira Boudway. He joins us now. So Ira, this happened even before the Super Bowl, but the Super Bowl was kind of like a litmus test for all of this.
Yeah, you're seeing sharps, professional bettors get into prediction markets more and more, and they're sort of diverting some of the money that they would normally be, their bankroll that they would normally be wagering with all different manner of sports books. They're coming to prediction markets with it, and they like it because they don't get limited out. So if you are a really good bettor, most traditional sports books are going to recognize that at a certain point, and they're going to start capping how much you can wager. Makes it hard to make money. Whereas the prediction markets, they are matching up, right? Two sides of an exchange. They don't care who, they're keeping a little piece. They don't care who the winner is. So they don't limit these bettors. They can do as much as they want.
Okay, they don't care who the winners are, but what about states? What about regulators? What about those state governments that say, wait a second, we just figured out how we can tax these winnings from the, quote unquote, traditional gaming platforms, the DraftKings and the FanDuels. Now we have to figure out what to do with, Kalshi, Polymarket, and Robinhood?
Yeah, I mean, this is a legal battle that is unfolding right now where you're seeing pretty much every state that has legal online sports betting coming forward and saying, we're not okay with this. We want Kalshi, Polymarket, other prediction markets to cease and desist. We think that this is sports gambling by another name, and we have jurisdiction over it, and we have the right to tax it. That's really what they're concerned about. On the other hand, the prediction markets say, look, we are a different thing. We are regulated by the CFTC. That preempts any kind of state control, and we're allowed to do these types of contracts in sports as long as the CFTC lets us.
Well, the CFTC hasn't said a whole lot, it feels like. They're regulating it, but are they doing very much? And I guess the other group or stakeholders that have a lot of money at stake here are the professional sports leagues. Where did they fall in all of this?
They initially were really skeptical. We saw the first inklings of this last year around this time with the Super Bowl. Crypto.com and Kalshi came forward and started offering sports events contracts. The CFTC didn't stop them. The sports leagues came forward and said, look, we have all of these things that we do to protect our interests when it comes to sports betting. We have monitoring for suspicious trading activity. We have prohibited bettor lists. We want to make sure that if this type of activity is going to happen in this context, that we duplicate those efforts. And so that has started to happen. You're seeing platforms like Kalshi and Polymarket start to use some of the same firms and the same systems to monitor for suspicious trading, to try to keep lists of insiders who aren't allowed to trade on these platforms. So But the question of kind of, is that enough?
Yeah.
And is it sufficient to satisfy regulators, to satisfy the public, to satisfy the leagues, is all kind of to be determined.
I mean, so many people, Scar, are betting on sports right now. I mean, if you look at this, the data, especially for men of a certain age, it's like the
18 to
majority.
49?
Yeah, it's like the majority of them in some cases.
And it's the Wild West right now while we feel our way towards some kind of resolution. Ira, thank you so much. Ira Boudway here at Bloomberg Business Week with his big take story on the prediction markets. Now, prediction markets are facing questions about pricing infrastructure as they grow. Adam Morgan McCarthy of Kaiko says the great split is happening. Speculative markets are increasingly separate from use case-driven institutional adoption. Adam joins us now with more. Adam, it's great to speak with you. And of course, that great split speaks to this idea that when you are using institutional adoption, you expect a certain quality of service, you expect a certain clearance to happen, a speed, an efficacy that perhaps doesn't exist with something that's speculative. How would you grade the infrastructure of prediction markets right now on a grade from A to F?
I think the infrastructure so far is, kind of, I'd give it a B minus maybe. We're integrating into some of these prediction markets into our data streams. So, we're moving not just from being crypto, but adding in these prediction markets. That side of things are great. We're looking at the API docs, those things. But when it comes down to how the markets are priced and how people are settling these, there's some questions to be asked across a lot of these venues. I think in the kind of efficacy of it, as you say, are they scraping the data from a public source? Is there potential to kind of arbitrage that through having a quicker system and knowing, if you're using Yahoo Finance to settle an equities market and you have an API access, are you getting the kind of final daily price a little bit quicker and you can get an edge over other users on that market? And I guess that's where I would say it goes from, kind of a B to a B minus. And it's a drawback for the markets right now. It shows that they're in their infancy and shows for sort of the work to be done still.
Well, where does the work need to be done? Is this a case where, in your view, Adam, the market can actually solve this, or do regulators need to step in?
I think it's probably regulators. I mean, we've had this in crypto markets now. So, not every crypto exchange uses an independent rate provider for their derivative settlement, for their perpetual futures. And some of them use their own spot markets, or they're heavily tilted to their own spot market. There's no incentive for them to change. But when you got MiCA and, MiFID and these things in Europe, when you want to become compliant, when you want to set up in a EU state, then you're going to have to say, all right, now I need to use an independent provider. And we're seeing more and more of that. We work with the likes of One Trading in Europe and Gemini globally. These guys have made that move early, but that's because they want to be active here, and that's because they were kind of, getting ahead of the regulators. There's no incentive otherwise for crypto venues, and it's the same for perps. I think without that sort of regulatory for Polymarket, without that regulatory kind of nudge, they're not going to go and do this independently because, it's cheaper, it's faster. You can list a market in seconds on Kalshi, on Polymarket, on Augur, wherever you are, but it's not as robust, and it's going to lead to issues. People will end up losing money. So I think it's a regulatory thing that has to come. And, seeing some of these firms acquire DCMs and moving into the kind of more oversight of the CFTC, I think that should eventually come. And it's something that we're definitely kind of, a proponent of, that the regulators need to come in here and say, you should have a regulated price on provider for this.
What are you pointing out to the regulators to encourage that kind of intervention? Does there need to be some kind of event for that to happen?
Sadly, these things usually fall back on an event, a kind of flashpoint that will remind everyone that, hey, we need to actually be kind of doing something properly here. But we're working with the regulators, I think, mainly on an educational basis. How we chat with them globally is usually sort of, teaching them about what they need to watch in this market and what's kind of where the pitfalls are. It's kind of collaborative still, rather than really kind of, pushing more for things. It's kind of just catching up, because these things have moved so quick. If you're not kind of in the weeds like we are, then you're not really tracking all the stuff. So right now it's still educational, and we're kind of gently saying, hey, we've got more compliance in Europe. That is a badge of approval. Most of the major crypto index providers we want to get that. Kaiko has it, some others have it. Those kind of things are important, and that stuff we kind of think there needs to be more of. Especially maybe in the US eventually. But I think, over the past year, it's one of the things that's probably been the main plus point in crypto is that there have been regulatory kind of advancements. We've got token listing standards. We've got these things. Prediction markets are crypto adjacent, so hopefully we'll see some movement there too.
You know what's interesting about prediction markets is I've started to use them to sort of understand how the market is thinking about certain events, like who President Trump will choose for a new Fed chair. Relied on that a lot ahead of that announcement just a few weeks ago. But there are also things you can predict, like the number of times an executive will say a certain word on earnings calls. There are things like, you can bet on the return of Jesus, I believe, coming back in a certain year. So there are things that are kind of like outside of the market. Net, Adam, is this a good development for society? Is this good for us?
I think it's an interesting one because, from where I'm sitting in Europe, you guys were talking about the sports gambling before. Gambling's huge here, and it's kind of been around for a while. Paddy Power in Ireland and the UK it's a kind of household name, so it's nothing new to me. But there are definitely kind of drawbacks to that. I think it's interesting when you've got some markets, an up-down market on Bitcoin or on silver and gold, and let's say you're trading a perpetual future long on silver, and you buy the down market to hedge and reduce your margin cost. That's cool. That's a value. If you want to trade the Fed decision and you're already trading Fed futures, there's a 5 or 6 percentage point gap there. Okay, you can trade that. Betting on who's going to catch the first down, all of these things, it gets to a point in football where you've got people betting on how many throws there will be, or will there be a throw in the next 45 seconds. Those things, I don't know if those are bringing value to society more broadly. And that's where I think there needs to be also maybe a little bit more tightness on how what we list, because people will trade them, and obviously it can be detrimental for some folks.
All right, well, I appreciate you allowing me to go a little existential. Adam Morgan McCarthy of Kaiko joining us from Paris. Thanks so much, appreciate it. Hey, some breaking news crossing the Bloomberg terminal just in the last few minutes. FTX co-founder Sam Bankman-Fried currently serving a 25-year sentence for fraud stemming from the collapse of the cryptocurrency exchange, filed a long-shot request for a new trial. Scarley's arguing that new witness testimony could refute the prosecution's case.
Yeah, this motion was dated February 5th, but it was docketed today in Manhattan federal court. It was filed pro se, which means that Sam Bankman-Fried is representing himself. This filing is separate from a formal appeal of that 2023 conviction that led to his 25-year sentence. Separately, I believe there's been reporting that his parents have been lobbying President Trump for a pardon, the way that President Trump has pardoned others, like the Binance co-founder.
All right, well, we'll keep an eye on that. Coming up next on Bloomberg Crypto, Robinhood and Coinbase earnings are on deck. More on that after this.
We're about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. Warner Brothers Discovery has confirmed it received an amended tender offer from Paramount Skydance. It says it will, quote, carefully review and consider the offer. Paramount said in a statement today it will cover the $2.8 billion termination fee that Warner will have to pay Netflix if it ends the already agreed upon deal. Shares of Warner are up more than 2%, while Paramount, Skydance, and Netflix are also higher. Marriott shares surged to a record high after the hotel operator said it expects credit card fees to grow. That's thanks to an increase in the royalty rate it charges branding partners. The company also delivered an adjusted EBITDA forecast for the full year that topped the average analyst estimate. Shares of Spotify also jumped the most in nearly 8 years after the music streaming giant added a record number of users last quarter, far surpassing analyst expectations. The company credited its Wrapped campaign and the launch of an enhanced free tier for the growth. And lastly, Robinhood shares are rising after Wolfe Research raised its recommendation on the financial services platform to outperform from peer perform. The analyst cited potential upside from prediction markets growth as a reason for the upgrade. Robinhood reports earnings after the closing bell today. Those are your midday movers. I'm Nora Melinda.
Falling crypto prices are causing crypto venture capital funds to rethink their strategy. The number of VC deals has been declining since last year and well off their peaks in 2022. So what kinds of growth opportunities are investors sold on in this crypto winter context? To answer that, we welcome Katrina Paglia. She is Chief Legal Officer at Pantera Capital. Pantera has been investing in blockchain companies since 2013. So in any kind of downturn, we tend to see companies and investors seek safe havens, go for the safety play. What's the safety play in crypto?
That's a great question. I think we're really excited about utility going forward. I think the stablecoin legislation that we saw passed last year really makes some interesting use cases for real-world application of stablecoins from a payment rails perspective. You're seeing additional institutional adoption of it. I mean, the U.S. Reserve actually has a stablecoin portion of the Treasury now, which is really exciting to see. In addition to that, real-world assets, tokenization. I heard you talking about it earlier. Prediction markets, also really exciting right now, kind of getting mass adoption. A bunch of them are popping up now. So those are kind of like the key areas that we're focused on.
Does the current crypto winter that we're in, and like last week's decline of more than 50% from those October 2025 highs for Bitcoin, does that slow down adoption of tokenization, for example, just to pick one of the things you talked about?
Yeah, I mean, I don't think it slows it down. I mean, I think if you take a step back, we wanted Bitcoin to hit $70,000 for so long, and we're here, and now we're kind of, lamenting a little bit coming down from the highs, which makes total sense.
Meaning you wanted it to hit when it was at $20,000
yeah, exactly.
or $30,000, but when you're at $125,000, do you want it to hit 70,000?
No, I mean, obviously you never want that, right? But I mean, I think we're looking at kind of a macroeconomic pullback, but really interesting to note, even though we may be in a bit of a downturn, the volatility we're seeing around this is significantly less than prior downturns. I mean, Pantera has been doing this for 4 different cycles now, and this is significantly less volatile than we've seen any of the prior ones since 2013.
Because of that institutional investor money?
Yeah, I think so. I mean, the maturity of the industry is significantly more than it was in the last cycle and the cycle before that. I mean, we're seeing TradFi and fintech companies come in. You're seeing the JP Morgans have their own coin now. I mean, it's very hard to say that this is not different from the prior downturns.
Fair enough. What kind of businesses are less appealing in this environment, though? Are there any?
I mean, there's opportunities in a downturn, right? I mean, because you're getting things at a better valuation, right? This is exciting for the venture capital firms. There's a flight to safety and a flight to stability when you do kind of enter these crypto winters. So we're looking for the more mature projects. Our check sizes are getting significantly bigger, even though deal flow has slowed down. Wow. Again, a sign of the maturity of the industry.
What about, to Scarlett's point, wouldn't a digital asset treasury company be less appealing right now? Look what happened to Strategy, $12.5 billion, loss in the most recent quarter, mark to market.
Yeah, the digital asset treasury, I guess, boom, for lack of a better word, does seem to have pulled back significantly. I think that we're seeing accessibility to these things more directly now than I think people originally thought that the instrument of the DAT was actually going to offer.
How much are VC investors waiting for a passage of the crypto market structure bill?
We are focused on it, and obviously we want it to come. The positive news is we're seeing the SEC and the CFTC start to move forward as well from a rulemaking perspective in their joint task force that they announced a couple of weeks ago. So we're excited about the 2 parallel paths, both from market structure and the regulatory clarity. But yeah, it's a huge focus for us. I mean, it's what I would expect it to be at this point, given how complex this bill is, how complex the legislation is, and you have so many different interest groups across the crypto industry. So it makes sense that there's a lot of conversations where people are lobbying for what is in their best interest. And, we're seeing conversations happen. It's moving a little bit slower than we would like it to, but it is progressing.
So if we look past that, and let's say that does actually get passed and get signed into law, what is the next catalyst that you're looking for? What do you need from Washington?
We need constructive rulemaking once it gets passed, because once the bill goes through, obviously there's a period of time before it actually gets enacted and you get the rules out there. So hopefully we continue to have the bipartisan support in the conversations on that.
What's the one industry that that the startups are looking to disrupt right now? I mean, we've seen everything from legal software to financial planning to insurance brokers. What's the one area that is getting a lot of attention?
It's hard to say one particular area. I do think that AI is really interesting from a blockchain perspective because you have the transparency, but then you also have the AI component on top of it. So we're starting to see projects really focus on the combination of the 2 technologies.
Makes sense. Very 2026.
Katrina, always good to see you.
Yes,
thanks so much for joining us. That's Katrina Paglia, Chief Legal Officer over at Pantera.
And that does it for Bloomberg Crypto. Please join us again, same time, same place next week. From New York, this is Bloomberg Crypto.